Eli Coombs founded Meehan Coombs with his friend and former colleague Matthew Meehan in April 2012. They sought to establish best practices and better align the interests of fund managers and investors. Focused on credit and distressed investing, Greenwich, Connecticut-based Meehan Coombs today has around $300 million in assets under management. Coombs' commitment to forging a better path makes him one of the most interesting new talents in the industry.
There's been a lot of talk about the future of the hedge fund industry, in particular given the strong performance of the equity markets last year and what appears to be a high degree of correlation among hedge fund strategies in the first quarter of this year. And so a lot of that talk is based on the assumption that hedge funds as an asset class will be under pressure because of their underperformance. Frankly, I think that quite the opposite will be true. Hedge funds will flourish in the next 5 years. And it's for maybe the flip side of that performance reason. And what I mean is this. In the next 5 years, interest rates are going to rise. And investors that have a high allocation to fixed income, long-only fixed income in particular, will mathematically have a challenge making money. And will have to look for other sources of return. And so while a lot of the industry and the talk around the industry has been focused on matching the performance of the equity markets, and that's been the dynamic in the last year, in the next 5 years, I believe the talk will be about how to protect against the poor performance of the long-only fixed income markets, and that's coming because it's just a mathematical fact. So my view is that not only will the hedge fund business grow over the course of the next 5 years because of this need to replace what will be an underperforming asset class, but it'll also change to meet the institutional needs of the underlying investors. And from that will grow true asset managers from what are boutique money managers right now. For us, the largest opportunity exists in trying to solve this most obvious problem, which is how to generate positive expected returns in a rising interest rate environment. And our strategy, because we're a long-short credit strategy that focuses on stressed and distressed corporate credit in the U.S. and Europe, is a strategy that naturally has a bias towards solving that problem. So we create portfolios very specifically to solve that problem. In that regard, we're lucky because we have a strategy that very clearly fits with what we think is the biggest risk/opportunity in the market for the next 5 to 10 years. But as a firm, we are also saddled with the challenge that I think every firm has, which is how do you grow in such a way that you align your growth with the interest of your investors and you create a true institution from a boutique money manager. I think unlike what was often the process in the industry 10 years ago, where you built into being an institution out of necessity, we tackled that problem early on in the development of the firm. And so our belief was if we built that capability to manage institutional capital or provide that solution for institutional investors early, then we would have a stronger firm. And it would be much easier for us to create different permutations of our portfolio or of our expertise to solve those problems for people if we had the infrastructure there to do it from the beginning.